Welcome back. A positive week for markets so far. We will see if we can break the current 7-week stretch of losses. And for more on this, we're going to bring in Michael Antonelli, Managing Director and Market Strategist at Baird. Michael, always great to see you here. And here's your thesis. We're not going to see a V-shaped recovery. I couldn't agree with you more, but spell out your reasoning, please.
I was going to say, Jared, you stepped all over all of my content in this session.
I'm glad you're a listener of the show. Thank you.
I appreciate that. So there's this notion of, how are we going to get out of this? When are we going to get out of this? Are we going to have a V-shaped bottom? Are we not going to have a V-shaped bottom? I've definitely been going out not only on my content with my clients about the fact that there's no V-shaped bottom here. V-shaped bottoms are completely comprised of the Fed getting really super friendly, putting a tailwind to us, some sort of fiscal impulse, something out of the government that's going to stimulate the economy. So neither of those are happening. We just know that. And by the way, the more the stock market rallies, the more the Fed doesn't probably want to see that. They want to tighten financial conditions. So I got to get into people's heads. Hopefully your viewers here, my clients, everybody, that this is not going to be a V-shaped bottom. It's going to take us some time to get through this, but that's okay. We are going to get through this.
How long are we going to take to get through this, Michael? Because I know you're a student of history. You like looking at what we've seen before in these types of pullbacks. So what's sort of the average duration of these things?
I'm a big evidence-based investing guy. Just means kind of looking at the evidence of history, every data point that we have, and saying, what would happen in an average bear market? How long would an average one take? Doesn't mean it will be the average, but I think it's a good place to start. So if you're looking peak to trough, the average bear market's about 338 days, so a little bit less than a year. If you're talking peak to trough, back to peak, that's about 600 days, so a little over a year and a half. That's a good place to start. Could this be worse? Sure. Could it be better? Sure. We don't know what the eventual outcome will be, but there's a couple indicators right now, Julie, that lead me towards it not being worse. Number one is the move in credit recently. Look at kind of the move in some of these high yield indices. We could talk about that if you want, but credit is not deteriorating at a worsening rate. And you've also started to see the terminal rate for the Fed start to come down. It's kind of hanging around the 3% rate right now. At least that's not out of control. The terminal rate's not rising daily. So I do think that if we're going to think about how long it might take to get out of this, a year is a good place to start. That's the average kind of bear market time frame to get to the bottom.
Mike, I want to get back to that V letter. If you think about it, half of it is the down move. How far do we go down? Because I haven't seen capitulation yet, and we've been talking about these research analyst notes, Citi kind of joining the fray here, saying that we should expect lower prices for equities.
It's tough, right? You get into these situations, you're a strategist, you need to make a call for your firm. Stocks are down, you downgrade them, stocks are up, you upgrade them. We've seen kind of not only bearishness happen at the lows, you can see bearishness happen on the way back up too. So I'm an intraday guy, my friends. I'm intraday. We were down 20% intraday. So that's a bear market. So we're not doing any semantics on whether it's a bear market or not. How much deeper can we go? I guess you only think it goes deeper if you think you're in the terrible, terrible recession camp, and I am not. That's deeper. The worst of all bear markets lie in the really bad recessions, and I don't think that's the case. I talked earlier about the recession of 1949, which was kind of a mild recession after a really inflationary period and a monetary tightening period at the end of World War II. I think that's a good analog, in my opinion. Can we get much worse? Sure, but credit's going to have to deteriorate. I think kind of the near-term low for stocks is in. Credit, like I said, look at the high-yield indices, would have to get much, much worse, I think, for us to keep making new lows from here. Can't say it's possible, but credit, I think, would have to lead the way down. And right now, it's got a tremendous 3-day bounce going.
So, Mike, do you cover your eyes and continue to not look at your 401k for the next year and just kind of like ride it out?
I was saying the other day, I think I've looked at my 401k twice this year. It's definitely one of the behavioral tricks your viewers need to understand is that the more that they look at the stock market, the more they look at their account, the worse of an investor they probably are. You're prone to making bad decisions. So what I looked at is, my friends, the 11 worst years. Okay, the 11 worst years in stock market history, calendar years. And by the way, down 10% counts as the 11th worst year. Can you believe that? Anyway, so if you were to look 3 years and 5 years out, 3 years out, there's only one negative return. 5 years out, there's no negative returns. We just come down to the fact that in these sell-offs, future returns get better. That 11 worst years in history, 5 years out, there are no negative returns. So I'm trying to focus people a little bit further out the curve and remind them that, yeah, this stinks. It really stinks. At least we're going to break this 7-week losing streak. That's good to celebrate that. I hope I didn't jinx it. But I think we need to focus on going a little further out.
Yeah, Mike, we would need a big drop today.
Mike,
you would, yeah.
Real quick here. You said you're an intraday trader. Day trading, what do you like to trade?
Listen, I did NBA Top Shot for a little while during the bubble, but I When I think about intraday trading, it's probably more along the lines of, is there some sort of technical analysis or some sort of trend analysis I can use? I try to keep that stuff to a minimum. The more you do, the worse your results are. But I am definitely still a stock guy at heart. And if I was going to day trade, it would definitely be, probably in a large cap tech stock with some technical trend, but I try to keep that to a minimum.
One more thing here. I do a Yahoo Finance Plus webinar every month, and I think it would be perfect for the next one or something in the future. I'm just wondering, I'm putting this out there. You don't have to say yes, but we definitely want to target you.
Contact my people. I'm in.
Thank you.
Have your people call his people, Jared.
Yeah, exactly.
I hope you got out of NBA Top Shots at the right time,
I did.
By the way,
yeah.
Mike. All right. I hope you have a great holiday weekend. Do some barbecuing, listen to some yacht rock, and have a good one. Mike Antonelli, Managing Director and Market Strategist at Baird. Thanks so much. Appreciate it.